We went vertically integrated as a company um, just about a year after we last spoke. So I think it was 2021. And what vertical integration means is we brought our property management in-house and we brought
Hmm.
our construction management in-house. And then we launched a trademarked procurement process that we call Shore Home. And I'll start with that procurement process as being one competitive edge that a lot of other groups aren't doing. The vast majority are not. So, Sure Home is a process where we're going directly to manufacturers and we're having them manufacture materials for our properties overseas. They're custom designed, they're custom built, they're shipped from Taiwan and other places worldwide to Texas. They're trucked up to Dallas where we have warehouses, and in these warehouses we package these ready to go kits for our team with most of the materials that they're going to need to turn our units. And so they go in these little
Wow.
crates and they get put into a shipping container, gets trucked off to the property that we're closing or just closed, gets set usually on the back side of the property. Our team is on site now in-house day one, opening the shipping crate. There's a bunch of individual kits for, say, 50 units, and they can get started right away with things like ceiling fans and doorknobs and light fixtures and shower rods and cabinet pulls and in some cases, backsplashes and paint and screws and nails and tools. They have most of what they need. We do not ship the bulky, heavy custom items like countertops, flooring, windows, appliances, but everything else is put into these kits, generally speaking. So, what does that do? Well, one, it gives us brand recognition in the industry. No other properties in the surrounding area have the custom materials that we have. And why that's important, I'll give you one practical example just to drive this point home. You think about a flush mount light that you might go buy at a local hardware store, a Lowe's or Home Depot. You put that up there. First of all, you're going to pay the markup for the retailer. Okay, you're going to have inefficient packaging with plastics and styrofoams and all this stuff. Most of them will have two light bulbs in there. Hopefully they're LED, or you have to go out and buy them. And then if you break that light, either the person installing the light or say a resident by accident breaks that light, what do? You have to go back to the store. You have to buy a new light, the whole entire kit, potentially the bulbs as well. And that could be a $30, $40 fix. Our custom designed lights, the flush mount lights, we have the parts and components to actually fix these materials on site. So we actually have glass that fits into these so that if the glass cracks, we just replace the glass sleeve for maybe 50 cents. We don't have to go out and replace the whole light. In addition, there's one light bulb that comes with the LED instead of two. So, it's just these little things. And you think, well, who cares? It's $30, it's $40. Well, we've acquired over 21,000 units as a company. So the little things do add up. When we're saving $10 times 20,000 units, that's a big number. And so that cost savings flows through to our investors. So also, last thing I'll say about procurement process, it's shortened our turnaround time to 14 to 21 days to fully renovate and turn a unit. I can't remember what it was before, but it was like 30 to 35 days or something like that. So we've tremendously shortened down that time frame. And once again, it's environmentally friendly. When we order shower rods, there's going to be a box of, say, 500 of these shower rods without the styrofoam, without the colored cardboard packaging, without the plastics, without the bulk and the weight and the size. It's just very inefficient to do things like we're doing at scale without doing something like our little mini Amazon, so to speak. So that's one competitive edge among, of course, having your own in-house property management and construction arms.
Wow. 21,000 units. I didn't realize you guys had acquired that many. So are you standardizing like a flush mount light across all 21,000, or is it different ones in different properties?
Yeah, good question. So we have two trademark brands under the Ashcroft umbrella for our properties. Our Halston brand, which means that when we buy a property, we rebrand it. New website, new marketing, new monument sign out front. Halston is what most of our properties are. That's for our newer, nicer, higher end finished properties. Then we have the Elliott, which is for our more vintage properties, say something that we're holding that was built in the 70s, 80s, early 90s. That might be an Elliott. So there's slight, subtle differences to what we do on turning these units. The Halston's going to have the granite quartz countertops and the stainless appliances and the crown molding and all the best of the best that we have to offer. The Elliott's going to be just scaled down slightly, a faux wood flooring, faux 2-inch wood blinds, maybe stainless, maybe not. Maybe used appliances instead of brand new. There's just subtle differences because the ROI isn't necessarily justified on some of the older properties. You're not going to get the rent bump that we would get on some of our newer, nicer product. But generally speaking, to answer your question, the small things like the pendant lights and the flush mount lights and the door handles and doorknobs, those are generally all the same across the board for our properties.
Yeah. Wow, that is super interesting. I never even considered that, but when you have that type of scale, now all of a sudden these changes make a huge difference. Even if it's just a little bit per unit, that adds a lot to the bottom line. So, you also made a change when it comes to insurance. Can you kind of share a bit about how your insurance works, like portfolio wide?
Yeah. So again, hitting scale, this would be a conversation for GPs and LPs to be aware of when you're a company or working with a company that has thousands of units. We, at some point here about 3-4 years ago, went with a portfolio wide master policy. And some benefits to that is that we operate in Texas and Florida and Georgia and North Carolina. Well, as many of your listeners probably know, and myself being a Florida resident, insurance has gone up tremendously over the last 5 years. Specifically, Florida and Texas have been impacted the most out of all 50 states. So the master policy helps us save money by putting all of our portfolio under one policy. And I'll give you a practical example of how this played out in real life for us in Dallas. That several years ago, the unexpected deep freeze, some people call it snowmageddon, happened unexpectedly, and it affected a lot of our deals. I think we had maybe 17 properties out in Dallas at the time. So let's say 8 of these properties were affected in one way or another from this deep freeze, whether it be busted lines or things breaking and having to displace tenants and stuff. So we pulled one claim with one deductible, and we covered all the properties that were affected at that time in Texas. And then, of course, we have adequate cash reserves on hand to account for unexpected events like this. So we never had to stop the cash flow distributions during that period of time for that reason. And so it just basically saves us overall. So when we buy a new deal like we're buying in Orlando right now and the insurance is really high, it's offset by some of the North Carolina and some of the Georgia properties and things like that. And the last thing I'll say about a portfolio policy is that we have full actual replacement cost coverage. So a lot of policies, if you really read through the terms of maybe even the one that you might have for your single family home, a lot of policies just kind of give an average or estimate replacement cost, based on other properties nearby. You may not be fully covered in the event that something really catastrophic happened. So we have full actual replacement cost, which covers all the labor, all the materials, everything of the actual cost it's going to take to rebuild. And then we get reimbursements for what would have been paid to us in rent if we have to move or displace tenants. And so we're not out that cash flow or income in the event that something like that happens. So another creative way, again, operationally speaking, that you can help investors and save money and be more efficient.
Yeah. A couple of key things in there with the replacement cost and then rent replacement too. I'm sure if all of a sudden a property burns down, that you can rebuild it, but in the meantime, how are you supporting your business? So I think that's really smart. And then just from an ease standpoint too, ironically, I'm going through a claim process right now because we had a hailstorm come through where I invest in Michigan City, Indiana, just about a month or two ago. And I've got all individual policies with several different insurers. But the storm hit the whole area, so
Right.
uh, I've got all these different claims going, and it is just it's a lot of chaos. It would have been so nice to have one policy. I file it across all the properties that were affected, and then I don't have to worry about working with 20 different adjusters or whatever it is. So that's a great point. Um, so how many deals have you done to this point? Up to this point?
As a limited partner, I've invested well over 50.
Okay.
I've lost count at this point. I used to keep that as a little metric, but over 50, probably slightly less than 100. So somewhere in that range. Yeah.
Wow. That's incredible. What would you say is the biggest change or biggest lesson that you've experienced as you've gone through lots of different deals? I'm sure there's been some that have been painful
Yeah.
and some that probably weren't as painful, but still a good lesson to learn.
Yeah, a couple things that come to mind. The first is that you got to bet on the jockey and not the horse. It really comes down to the team, their expertise, their track record. Are they a real, true operator? Do they intend to be in this business long term, or is this again something they heard about a couple of weeks ago and thought, yeah, I could be a syndicator. Let's try it out. That makes a huge impact. My most successful deals are with the tried and true operators because they have connections built. They have broker relationships. They have relationships with insurance and with lenders. They can pull strings. They can make things happen, right? They know what to do if X, Y, and Z were to unfold. So just think about that, because as a limited partner, the only thing, well, not the only thing, the biggest thing that we have to look at as to, the operator is the experience and the track record. Do you specialize in what you're doing? How many times have you done it? What have the results been? If you had a deal go bad or sideways, what were the lessons learned? That's the biggest chunk, in my opinion, of the due diligence. The second thing I've learned, especially over the last 2-3 years with these rate hike cycles and these different debt structures, is betting on appreciation isn't always the best play. And thankfully, I knew this early on from flipping houses and having some not be so profitable.
Yeah.
And then realizing that many of them were so profitable because the market was, on fire at the time, and it wasn't really me or my skill set. So I'm a cash flow focused investor. That's what I'm vetting the most in a deal. And that's what I'm projecting for myself as I look forward and I say, where could I potentially be in 5 years or 10 years? And when I run that kind of analysis, I'm really just focused on cash flow, and I'm not buying into the, double your money in 3 years, yada, yada. That was all the hype before this rate hike cycle. And, in some cases it happened. In a lot of cases it didn't. And especially in the 2021 deals, it's highly unlikely that that's going to unfold in those deals. So, I like a combination of cash flow, potential equity upside, and tax advantages. So I try to find a sweet spot within there. And the last thing I'll say about lessons learned is you got to check in with your psychology. So I've always been a dollar cost average mindset investor, and it wouldn't matter if I wasn't even a real estate guy and I was a stock market guy. If I was going to do stocks, I'd be buying in consistently with equal amounts of money year to year into some diversified index fund or something like that, because you just can't time markets. You just can't. There's too many things obviously out of our control. What the Fed does, what the government does, wars, inflation, you can't predict this stuff. So you just keep dollar cost averaging. I had deals from 2015, 16, 17, 18, 19 do incredibly well as a limited partner, better than most of the deals I did actively. And then I'm going to have some subpar deals from 2020, 21, maybe 22. We'll see. And then now, again, as prime time opportunity, I might have some of the best deals coming up again than I've ever done here in 24, 25, 26. So time will tell. But, if you ask investors, are you long-term? Most investors will say yes, but the psychology works against you, right? Because when things start to go south, you go, oh, wait a second, maybe I'm going to sit on the sidelines. Maybe I'm not going to invest anymore. Maybe I'm going to change strategy. So a lot of people are in that camp right now. It's unfortunately the case, but it's why I wanted to come on your show and really get this point out to others that are thinking about commercial investing right now.
Yeah. Yeah. To your point, like if you are a cash flow investor, and I love hearing you say that, because I've interviewed so many people on this show, and everyone who is more of the appreciation investor
Mm-hmm.
mindset, that's what they're going after. They have great stories of winning big. And then they've all had, if they've been doing this for long enough, they all have the story of almost or at some point losing everything and it almost destroying their life,
Yeah.
especially in the '09 crash time period. It's almost like a gambler, because you can't, like you said, you
Yeah.
can't predict the future. And so if that's the main thing, yeah, you're going to have some high times, but you're also going to have some struggles at times. But if you have cash flow, to your point, like, if the market goes up, that's great. You capitalize on that. If it goes down, you're still collecting cash flow on a monthly basis. The
Yeah.
underlying asset value, yeah, it might go down temporarily. We know over the long term, it's always going to appreciate. I mean, at least if you look at historical trends over any long period of time. So,
Yeah.
um, so I think those are all just really, really great lessons to take away. And I can tell you've had a lot of experience with this, and you're speaking from experience. You're not just kind of somebody who's just getting started and reading this stuff out of a book. It comes from hard lessons learned. So,
Yeah, I'll leave your audience with one actual true case study here, case in
yeah,
point to what we're talking about. So, a lot of syndicators will they'll outline a 3 to 5 year business plan. And there's nothing wrong with that, but that's the most typical business plan. We're going to
mm-hmm.
get in, add value, renovate, sell. Okay, cool. I do a lot of those and I love them. But I've also worked with operators that never intend to sell. And when I say never, it doesn't literally mean never. It just means we don't know when we're going to sell. We might sell in 10 years, 20 years, 30 years, next year. We don't know. So some of those deals I got in 2016, early 2017, I'm still in them right now. They put longer term fixed rate debt on these deals. And I tell you, every year, the cash flow just keeps going up and up and up. There's no chance or possibility right now of a capital call, of paused distributions. There's no reason. The valuation may be lower, but to your point, Kirby, every year, approximately that cash flow goes up by 1%. Some of these deals are paying out to me right now 15 to 17% annualized cash flow.
Wow.
And they don't need to sell, and they're not going to sell, at least not right now. Ask them in 5 years, maybe. But the cool thing about strategies like that, when it makes sense, you can refinance and send money back to your investors. We saw that happen a lot leading up to the recent rate hike cycle. And it's why I balance, diversification is what I'm trying to articulate here in a poor way. I diversify with a strategy like that, with a 3 to 5 year hold over here, with a multifamily apartment there, with a self-storage here, with a mobile home park there, with a car wash over there, with a note lending fund over here. Diversification is so important. And there's so many ways you can be diversified, even within commercial real estate, in my opinion. And that's what I've been doing this whole time, at least since 2015.